There's a market worth over $600 trillion that almost nobody understands. It nearly destroyed the global economy in 2008, and it is now 10 times bigger than it was then. Warren Buffett called its components financial weapons of mass destruction back in 2003. He was right. They triggered the collapse of Lehman Brothers, the bailout of IG, and the near destruction of the entire banking system. The response to that crisis wasn't to eliminate these weapons or even reduce them. It was to make them bigger. Today, the derivatives market is worth more than 6 times the entire global economy. When it explodes, and it will explode, there won't be enough money in the world to bail it out. Most people have never heard of derivatives, and even professional investors struggle to explain them. But these complex financial instruments underpin every major bank, every pension fund, and every government bond market on Earth. To understand why derivatives are so dangerous, start with what they actually are. A derivative is a financial contract whose value is derived from an underlying asset. That sounds simple until you realize the underlying asset can be anything: a stock, a bond, a commodity, an interest rate, a currency exchange rate, even the weather, or the likelihood of a company defaulting on its debt. The derivative doesn't require you to own the underlying asset. You're just betting on which direction it will move. It's like buying insurance on your neighbor's house burning down. You don't own the house. You just collect a massive payout if it burns. That's a derivative. The most common types are futures, options, swaps, and forwards. Each of these can be useful for legitimate hedging. A farmer might use a futures contract to lock in the price of wheat before harvest. An airline might use derivatives to hedge against rising oil prices. But the derivatives market isn't dominated by farmers hedging wheat prices. It's dominated by banks making leveraged bets on interest rates, credit risk, and currency movements with borrowed money. And here's where it gets dangerous: the notional value. The notional value of a derivative is the face value of the underlying asset. But the actual money at risk is usually much smaller. If a bank enters a $100 million interest rate swap, the notional value is $100 million, but the bank might only put up $1 million in collateral. That's 100 to 1 leverage. If the bet moves just 1% against the bank, the collateral is wiped out. If it moves 2%, the bank owes money it doesn't have. Now, multiply that by thousands of contracts across dozens of banks, and you have a system where a small market movement can trigger cascading failures. The real problem is complexity. Modern derivatives are so complicated that even the people who create them can't fully predict how they'll behave under stress. Credit default swaps, one of the derivatives that destroyed the system in 2008, were supposed to provide insurance against bond defaults. In practice, they became side bets where investors who didn't even own the bonds could gamble on whether those bonds would fail. AIG, the insurance giant, sold hundreds of billions of dollars worth of these credit default swaps, essentially insuring banks against losses on mortgage-backed securities. AIG collected premiums and assumed the risk was minimal because housing prices had never fallen nationwide before. When they did fall, AIG owed tens of billions of dollars it didn't have. The US government had to inject $180 billion to prevent AIG from collapsing and taking every major bank with it. But here's what truly makes derivatives terrifying. They create counterparty risk that spreads like a virus. If Bank A owes Bank B money on a derivative contract, and Bank A fails, Bank B doesn't get paid. Now Bank B can't pay Bank C, and Bank C can't pay Bank B. The failure of one institution cascades through the entire network in hours. That's what happened in 2008 when Lehman Brothers collapsed. Lehman had over $35 trillion in derivative contracts when it went bankrupt. Every institution that had traded with Lehman suddenly faced losses they hadn't anticipated. Some of those institutions failed. Others survived, but stopped trading with anyone they didn't absolutely trust, freezing the credit markets and turning a financial crisis into a global recession. The lesson from 2008 should have been to ban or severely limit derivatives, especially the most dangerous types like naked credit default swaps. Instead, the Dodd-Frank Act created some reporting requirements and moved some derivatives to central clearinghouses. But it didn't reduce the total size of the market. In fact, the market grew massively. From $60 trillion in 2008 to over $600 trillion today, the big banks argued that derivatives were essential for managing risk and providing liquidity. Regulators, captured by industry lobbying, agreed. The result is that the financial time bomb didn't get diffused. It got 10 times bigger. Let me show you what happened in 2008 when the market was only $60 trillion, because understanding that crisis reveals why $600 trillion is a civilizational threat. The crisis didn't start with derivatives. It started with subprime mortgages. Loans to people who couldn't afford them, bundled into mortgage-backed securities and sold to investors. But derivatives are what turned a housing bubble into a global catastrophe. Banks didn't just hold mortgages. They created complex derivatives based on those mortgages, amplifying both the profits on the way up and the losses on the way down. When Lehman Brothers, the fourth largest investment bank in America, collapsed in September 2008, its failure was catastrophic, but the cascade was worse. Lehman's bankruptcy meant that every derivative contract it had entered was now in default. Institutions that thought they were hedged against risk suddenly weren't. A European bank that had bought credit protection from Lehman found itself exposed to billions in mortgage losses with no hedge. A pension fund that had entered an interest rate swap with Lehman couldn't collect the payments it was owed. The interconnectedness meant that Lehman's failure instantly created losses at hundreds of other institutions. Some of those failed. Others survived but stopped trusting anyone else, freezing credit markets. The collapse of AIG was even more revealing. It showed how a single type of derivative credit default swaps could destroy a company with $1 trillion in assets. AIG's financial products division had sold about $500 billion worth of credit default swaps to banks and investors, insuring them against losses on mortgage-backed securities. They collected the premiums, believing the risk was zero. When the housing market crashed, AIG's credit rating was downgraded, triggering clauses that required them to post billions in collateral immediately. AIG couldn't come up with the cash. The Federal Reserve stepped in with an $85 billion emergency loan. That wasn't enough. By March 2009, AIG had received $180 billion in government support, the largest bailout in history. But the AIG bailout wasn't really a bailout of AIG. It was a backdoor bailout of every major bank that had bought credit default swaps from them. Goldman Sachs received $12.9 billion. Merrill Lynch received $6.8 billion. Bank of America, Deutsche Bank, and dozens of others received billions each. The government funneled money through AIG to make sure those banks didn't suffer losses on the derivatives they had bought. This revealed the dark truth about derivatives. When they fail, the losses don't disappear. They get transferred to taxpayers through bailouts. The banks that created the risk get rescued because allowing them to fail would crash the entire system. And today, the system has grown beyond the ability of any institution to rescue it. In 2008, governments and central banks committed about $29 trillion globally to prevent collapse. That was roughly 40% of global GDP at the time. It required every major government to coordinate, every central bank to print money simultaneously. It worked, barely, and it caused a decade of economic weakness, exploding government debts, and the political upheaval we're still experiencing. The derivatives market today is $600 trillion. If even just 10% of that goes bad, that's $60 trillion in losses. more than twice what was required to stop the 2008 crisis, and more than half of total global GDP. Governments don't have $60 trillion. They're already drowning in debt. There is no mechanism, no amount of money, and no policy tool that could absorb losses of that magnitude without collapsing the global financial system. The most insidious aspect of modern derivatives is their complexity. After 2008, banks didn't simplify their derivative books. They made them more complex, creating derivatives of derivatives. You can now buy options on credit default swaps, or swaps based on indexes of other swaps. This nesting creates exponential leverage, where a small movement in the underlying asset triggers massive changes in the value of the derivative pyramid built on top of it. No one, not even the traders who create these products, can model how they'll behave under extreme stress. The mathematical models all assume normal market conditions, continuous liquidity, and counterparties that always pay. In a crisis, none of those assumptions hold. And the triggers for that crisis are appearing now. The most obvious is interest rate volatility. Over $500 trillion in derivatives are tied to interest rates. After a decade of near-zero rates, the Federal Reserve hiked aggressively, creating violent swings that the system was not built to handle. Another trigger is commercial real estate. Over $2 trillion in commercial mortgage must be refinanced at much higher rates over the next 2 years. Many owners will default, triggering the credit default swaps written on their debt. A Japanese debt crisis, a Chinese real estate collapse, a European bank failure. The interconnection through derivatives is global. A failure anywhere propagates everywhere. When one major bank can't meet its derivative obligations, the cascade begins. Counterparties discover their hedges don't work. Margin calls force more selling. Central clearing houses face losses that threaten their solvency. Within hours or days, every major financial institution in the world is facing losses it can't absorb. This isn't speculation. This is pattern recognition and basic mathematics. A market that was $60 trillion nearly destroyed the economy in 2008. That market is now $600 trillion, and the capacity for a bailout is gone. The bomb is 10 times bigger, and there is no one left to defuse it. The only questions are timing and magnitude, and the answer is likely sooner and larger than almost anyone expects. Every time a financial weapon of mass destruction has been created, it has eventually been detonated. Derivatives are no different. The crisis is coming. You can't bail out a system you can't even understand. If you are ready to continue decoding the financial myths that shape our world, subscribe to Economythics and click the notification bell.